This is a podcast from the Business Times.
When I started researching companies back in the 1990s, I only ever focused on the fundamentals of their business and whether their shares were attractively priced. But over time, I found that it's just as important to consider whether the company in question is being run for the benefit of its minority shareholders. As the many REITs or property trusts and their sponsor groups reposition themselves in the face of higher interest rates, it's important to keep both these key themes in mind. Examine the fundamentals of the property trust and determine its fundamental value, but also consider what action the property trust sponsor group would have to take in order to unlock that value, and whether that action is aligned with their interests. Welcome to the BT Mark-to-Market podcast. My name is benpaul, and I'm a senior correspondent at the Business Times. This series of podcasts, which is based on my weekly column in the Business Times, aims to provide analysis and insight on market trends and corporate issues in Singapore. We're in the month of June 2024, and there have been two interesting deals in the REITs and property trust sector in recent weeks. I'm referring to the sale of ARA US Hospitality Trust and Cromwell European Real Estate Investment Trust by their respective sponsor groups. Here's a quick summary of what happened. After the market closed on May 27th, the manager entities of ARA Hitch Trust announced that they're being sold by ARA Asset Management, which is now part of Hong Kong-listed ESR Group, to a company ultimately owned by property tycoons Gordon Tang and Celine Tang. ARA Asset Management also agreed to sell more than 110.2 million staple securities of ARA Hitch Trust, representing a nearly 19% stake in the trust, to a company linked to the Tang family. Now, the Tangs were not strangers to ARA Hitch Trust. They already held nearly 53.8 million staple securities of the trust, which was equivalent to a 9.3% stake. So, with the 110.2 million staple securities they are now buying, they will hold nearly 163 million staple securities in the trust, equivalent to a 28.3% stake. How much are the Tangs paying for all of this? A filing on SGXNet showed that they are paying $5.2 million for the managers of ARA Hitch Trust and $34.2 million for the 19% stake in the trust, which translates to 31 US cents per staple security. That's nearly 11% more than ARA Hitch Trust's closing price on the day of the announcement. The Cromwell E-Reit deal was very similar. It also involved its sponsor group, which is an Australian-listed company called Cromwell Property Group, selling its stake in the REIT as well as its manager. The buyer in this case was a real estate investment group headquartered in Switzerland called Stoneweg. An announcement before the market opened on May 23rd said Cromwell Property Group would receive a total of 280 million euros under the deal, and that its 27.8% stake in Cromwell E-Reit, comprising 156.2 million units, would be sold for €1.52 per unit. That was nearly 3% above Cromwell E-Reit's closing price the previous trading day. If you do the math, you can infer that Cromwell Property Group's so-called European platform, comprising the manager and property manager of Cromwell E-Reit and other associated co-investments, is being valued at some 42.5 million euros under the deal. On the face of it, these two transactions might seem quite exciting for investors in ARA Hitch Trust and Cromwell E-Reit. With new sponsors backing them, they could be about to embark on a new and exciting phase of their growth and development. But here's the thing, the market prices of the two property trusts haven't budged since the deals were announced. The last time I checked, ARA Hitch Trust has moved sideways, while Cromwell E-Reit has actually fallen by about 3%. So why is there so little optimism the new sponsors will deliver better performance? To properly answer that question, it'd be useful to delve a little into ARA Hitch Trust and Cromwell E-Reit. Both these property trusts have a few things in common. First of all, neither of them are backed by the big local property players such as CapitaLand or Mapletree. Both of them also own faraway assets that are unfamiliar to many investors in Singapore. Cromwell E-Reit owns commercial properties scattered across Europe with a book value of almost 2.3 billion euros at the end of 2023. ARA Hitch Trust owns hotels in the United States, franchised under three major hotel chains, namely Marriott, Hyatt, and Hilton. Its portfolio had a book value of $751.4 million at the end of last year. Another relevant factor is that both property trusts are laden with debt. Cromwell E-Reit ended the first quarter of this year with an aggregate leverage of 41.3%, while ARA Trust's aggregate leverage stood at 44.1%. As a result of the nature of their assets, the condition of their balance sheets, and the identity of their sponsor groups, the market value of both these property trusts have taken a beating in the wake of the pandemic and subsequent rise in interest rates. Cromwell E-Reit is trading at a 2023 distribution yield of nearly 11% and a 32.5% discount to its NAV as at March 31. ARA Trust is trading at a 2023 distribution yield of 12.5% and a discount to its March 31 NAV of 61.3%. The point I'm making here is that there are a host of factors weighing down both ARA Trust and Cromwell E-Reit. Against the backdrop of elevated interest rates, investors have just naturally become concerned about risk, and there isn't a great deal of appetite for these sorts of property trusts. So, what can the new sponsor groups of these property trusts do to unlock value? And more importantly, what are the chances of that happening? I'm going to talk about that next.
The Business Times podcasts. Relevant, incisive, compelling content by some of the newsroom's most respected correspondents in markets, wealth management, and current affairs. Available on all your favorite audio content apps and at www.businesstimes.com.sg/podcasts.
And now, back to Market from the Business Times.
Earlier in this podcast, I said that ARA Trust and Cromwell E-Reit have struggled to garner decent market valuations in the wake of the pandemic and subsequent rise in interest rates. Now, to be clear, I did not mean that as criticism of the way they've been run by their managers and sponsor groups. Yes, they both probably had too much debt on their books as interest rates surged in 2022, but that was true of many other locally listed property trusts too. In fact, with interest rates stabilizing now, both ARA Trust and Cromwell E-Reit might well see their market valuations rise over time as the operating backdrops for their portfolios improve and as the strategies their respective managers are pursuing bear fruit. ARA Trust is clearly riding the post-pandemic recovery in hotel occupancy and room rates, and its manager has been actively optimizing its portfolio by selling weaker assets and using the proceeds to invest in more promising assets or to repay debt. Cromwell E-Reit, over the last few years, has proactively pivoted towards light industrial and logistics assets. This has helped support the book value of its portfolio and its overall performance, even as interest rates climbed. In fact, the new sponsor group of Cromwell E-Reit is keeping the current management team of the trust in place. So it's not that the managers of these property trusts have been ineffective and need to change direction. The problem, as I see it, is that public investors simply do not have much appetite for these types of property trusts. Will that change over time? Maybe, but even if the market value of these property trusts rise over time, they may never fully reflect the value of their underlying assets. It also seems unlikely to me that the new sponsors of ARA Trust and Cromwell E-Reit will immediately do anything to address that problem. The main reason control of these two property trusts have changed hands, in my view, was not to unlock value for minority investors. Instead, it was because the previous sponsors wanted to get out. Cromwell Property Group said last month that the sale of its European platform and stake in Cromwell E-Reit marked the conclusion of a $1.6 billion Australian dollar divestment program to reduce its gearing and focus its core competencies in Australia and New Zealand. ESR Group, on the other hand, has been trying to streamline itself following the completion of its acquisition of ARA Asset Management in 2022. In March this year, ESR Group announced the sale of ARA Private Funds, which is focused on traditional office, retail, and hospitality assets for $270 million. It said that sale was the first of $750 million worth of non-core businesses under ARA Asset Management that have been earmarked for divestment, in order to enable the group to better focus on so-called new economy assets. So, the sale of control of ARA Trust and Cromwell E-Reit by the previous sponsors was driven by their own internal business objectives, rather than wanting to do anything for minority investors. Similarly, from the perspective of the new sponsors, ARA Trust and Cromwell E-Reit have the potential to significantly enhance their business profiles. Cromwell E-Reit's manager said last month that its new sponsor, Stoneweg, which was established only in 2015, would become a stronger pan-Europe and US asset management platform following the deal, with some 8 billion euros under management. It's also quite easy to see why ARA Trust would be a useful addition to the real estate interests of the Tang family, which include Singhai Group and Acrophyte, which was formerly known as Chipping Sing Corporation. Both of those property companies were once listed on the Singapore Exchange, and interestingly, Acrophyte not only owns hotel properties, but has also developed its own hotel brand called Momentus. So, where does all of this leave minority investors? Well, as I said earlier in this podcast, many of them may have been hoping that the new sponsors behind ARA Trust and Cromwell E-Reit will somehow unlock value at the two property trusts. But short of winding up the trusts or taking them private, which may not be in the interest of the new sponsors, it's hard to see exactly what can be done. Indeed, it may seem unfair to minority investors that the former sponsors of these property trusts have been able to cash out after a protracted period of underperformance by selling the external managers of these trusts as they've done, while investors are still stuck holding on to the stubbornly undervalued securities of these trusts. This could, in my view, raise more questions about whether the external manager model allows for the interests of sponsors and investors to be properly aligned. This, in turn, could further fuel calls for a clear pathway to be forged for property trusts to internalize their management function at the behest of minority investors. This is something that's already happening at Sabana Industrial REIT. I've talked about that case a number of times, notably in episodes 34 and 38 of this podcast series, so I won't go into it again here. Except to say that clearing a pathway to internalization is not going to happen quickly. And in the meantime, investors really have to accept the rules of the external manager model that are currently in place. That means it's very important to not just look at the fundamentals of a property trust portfolio and work out if its securities are attractively priced, but also consider how the interests and motivations of its manager and sponsor group will shape their behavior. The bottom line for ARA Trust and Cromwell E-Reit, as I see it, is that the new sponsors that have taken over will probably not immediately do anything to lift their depressed valuations. That does not mean that ARA Trust and Cromwell E-Reit will not see improved valuations over time, but it does mean that investors will probably need to be patient. That's it for this episode of Mark to Market. I'm senior correspondent benpaul at The Business Times.
This is a podcast by The Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.